and good afternoon to all of you who are joining the webinar today. We are very pleased to host this lunchtime webinar. Our host today is the UCL Center for Ethics and Law, and my name is Iris Chu. I'm Professor of Corporate Law and Financial Regulation at UCL and a member of the center. With me today are two very distinguished speakers, Professor Douglas Arner, who address us on AI, regulating AI in finance, but in particular, and Dr. Maria Lucia Passado from the University of Bocconi, who has written some very interesting things on the EU AI Act and the regulation of AI in finance. Before we start, today's proceedings will be as follows. Professor Arner will take the floor for about 25 minutes or so to give us his views on some of his latest works, and then followed by Dr. Passado, who will provide her reflections and discussion for about 10 minutes or so. And the rest of the time to the hour will be a Q&A session, and we invite members of the audience to send in their questions through the Q&A function in this webinar. Please feel free to do so at any point in time throughout these proceedings, and I'll be moderating the Q&A when we get there. So before we start, I'd like to give a brief introduction to our distinguished speaker today. Professor Arner is Kerry Holdings Professor in Law at the University of Hong Kong, and he also holds the Sir Roy Good Chair in Commercial Law at the Centre for Commercial Law Studies at Queen Mary University of London. Professor Arner has many accolades, a lot of which are published on our event registration website. He's research affiliate at the Cambridge Centre for Alternative Finance, and he's held consultancies with various international bodies as well as policy organizations. Professor Arner has published prolifically in the area of FinTech and regulation, and his most recent book has been published by the Cambridge University Press. So please feel free to refer to our speaker bios that are published in full on our event registration website, and I will introduce Dr. Passado later on. Can I give you the floor, Douglas, to start?
Many thanks, Iris, and many thanks to you and to Anna Donovan and the UCL Center for Ethics and Law for the invitation to be here. I'm going to share a few slides, which will be available to anyone who would like a copy of those. And essentially, as Iris mentioned, what I want to talk about is the idea of building a risk-based framework for AI and finance. And essentially, the background to this is that over the past few years, I worked a lot with my colleagues, Ross Buckley and Dirk Zetzsche, on the book that Iris mentioned called FinTech, Finance Technology and Regulation. And one aspect of that was really a big picture review of the issues that we see leading up to the current situation in finance, and also looking ahead in many ways. And what we frame as the key sort of driving issues from the standpoint of this decade of the 2020s is really one around globalization and fragmentation. And of course, we are expecting announcements from the US administration on new tariffs any moment, which I think is in many ways a perfect example of some of the pressures that we're seeing. But we're also seeing this very much in the context of finance. We also flagged issues around technology, and that's where I want to focus today. And in the context of technology, I think the big picture is that if we compare this decade to the previous decade, the 2010s, in the 2010s, we were really looking at a series of emerging new technologies and thinking about how they might enable us to do things differently. We were thinking about mobile communications. We were thinking about blockchain. We were thinking about big data. We were thinking about the cloud. And I think when we look at technology in the 2020s, we're looking at a much greater scale. We're looking at gigantic platforms. We're looking at transformational technologies like central bank digital currencies. And of course, the focus of what I'm going to be speaking about today. And also, we identified issues around sustainability, which particularly in the context of East Asia, we're seeing increasing levels of day-to-day impact, temperatures in many cases, which are becoming difficult to bear without effective sort of cooling technologies, increased natural disasters, and the like. And coming out of that book, one thing that I spent a lot of time on is trying to frame what I think of as the issues going forward over the next 5 years. In other words, where issues around finance, technology, and regulation, after an extensive period of change in all three over the past several decades, where we're seeing things coming together over the next 5 years to really have significant changes. And I think one can identify five major areas. Certainly, one can think about cross-border payments, where we're seeing major developments. Second, the emergence of digital assets as a regulated industry. This is transformational. Third, if we think about sustainability moving increasingly, at least in jurisdictions outside of the United States and a few others, towards a mandatory disclosure framework, we see quite a different approach, RegTech and SupTech. And finally, what I frame broadly as data. And when we think about artificial intelligence, it's really about data analytics, and a variety of things where we're looking at strategies to use data, but also risks. And the second motivation from the standpoint of this present paper is another paper that Dirk Zetzsche, Ross Buckley, and I did with Brian Tang, where we looked specifically at the context of AI in finance. And if we looked at AI in finance over the past couple of decades has proven a very interesting case study, because finance has been one of the areas over the past 30, 40 years where the spend on technology each year has been amongst the most significant of across sectors. And the digitization, availability of large volumes of standardized structured data, combined with the financial incentives and the availability of resources, has meant that the financial sector has been one of the leaders in using various forms of machine learning and other types of traditional artificial intelligence. And in this earlier paper, we look at this idea from the standpoint really of a pre-generation AI world, of how, in the context of a regulated industry like financial services, one should approach these issues. And essentially, our focus was this idea that it was very important to take advantage of the existing regulatory frameworks. The fact that finance is a highly regulated industry, as well as being digitized and globalized, and that as a result, those regulatory frameworks for responsibility from the standpoint of management and others provide essentially the starting point in regulating use of AI in the context of financial services. And in fact, we argued that the experience of finance as a regulated industry and how those existing regulatory tools could be used not only in the context of finance, but also in other regulated industries like healthcare and the rest, but even potentially beyond regulated industries into areas like technology more generally, which have historically been much less regulated. And the idea was that this framework of putting responsibility on firms, providers, individuals, that this provided a strong way forward. And if we think about one of the key aspects of the book, we think about all of these experiences with new technologies in the financial services sector. And we argue that based upon the past couple of decades of experience, that the best approach to new technologies is what we frame as a graduated proportional risk-based approach. In other words, one thinks about balancing the opportunities and the risks. But to make this work, one needs to undertake a very structured approach, particularly to those risks, and think about the appropriate regulatory responses to those risks. And that is very much the context and the motivation for this paper that is just in its sort of final stages of writing up. And essentially, the argument here is that as we think about artificial intelligence going forward, that starting point is this risk-based analysis. In other words, to take seriously the risks and then to consider the appropriate proportional regulatory responses, balancing opportunities. And when we looked at the Human in the Loop paper, we focused very much on, if you will, the narrow context of regulated financial services. And the analysis here looks to go beyond that. And I think what the central point is that very often when we are talking about regulatory approaches to AI, we're taking far too many different aspects in. And that what we actually need to do is frame the different sorts of risks that we're dealing with. And if one frames the risks, one can then have a more appropriate regulatory design response to those risks. And the fundamental point is that different sorts of risks require different sorts of responses. There is no one way to take all of the risks that we're actually seeing into any single regulatory approach. And so what I want to really highlight in the context of this presentation is that idea at the heart of this paper of the core areas that I think one can think of from the standpoint of risk, and then think about the sorts of proportional regulatory approaches that we can think of in the context of the different risk categories. And over the past several years, spent a lot of time interacting with participants in this ecosystem, trying to identify from the standpoint of the different sorts of risks that we're seeing. And I think I can frame those in 5 different aspects. The first is what I frame as macro risks. Macro risks are really the big picture risks around things like superhuman intelligence, the fact that we could develop forms of AI that potentially, if one thinks about the paperclip problem, where one develops a superhuman AI that builds paperclips and destroys everything else in pursuit of paperclips, that this is, from the standpoint of a macro problem, it's a big picture issue, high risk, perhaps low probability. Similarly, we can think of issues around mass unemployment. In other words, the idea that perhaps the advent and more increased use of AI tools will actually cause widespread job losses. Or one can think about from the standpoint of energy use of AI, that energy use could have a different sort of one side is that the demands for energy of AI drive climate issues to a much worse level. At the other end, one could actually think of positive macro results, where, for instance, in the context of employment, AI provides tools that release human beings from the worst jobs and enables a much better life. Or one could think of, from an energy standpoint, the idea that AI provides a better energy system that actually provides for greater efficiency and addresses many of the climate issues. So, the first category I frame as macro risks. These are big picture, high uncertainty risks. And these are the risks that are not very well suited to traditional regulatory approaches. These are the sorts of risks that require essentially high-level strategic consideration, often based on scenario analysis to try to identify the possible range of outcomes and then design regulatory responses that try to reduce the likelihood of the worst cases while at the same time reinforcing the likelihood of the best cases. That then contrasts to what I frame as micro or sectoral risks. And in many ways, this was the focus of the Human in the Loop paper, the idea that if one looks at a sector like financial services, one can identify a range of issues such as fairness, or the way that AI is used, unintended consequences, these sorts of things. And from a regulatory standpoint, we have a lot of regulatory tools that we've developed over time that are quite capable of dealing with these sorts of micro or sectoral risks. There is, of course, this difference, as we argue in the Human in the Loop paper, between regulated industries like financial services or health, where you have this sort of framework, and areas outside of those traditional regulated sectors where perhaps you don't. And this is where many of the arguments about these sorts of approaches to AI regulation often come in. Our third category is what I categorize as infrastructure. And this is a very good paper came out from Leonardo Gambacorta at the Bank for International Settlements about 2 weeks ago, looking at the AI supply chain. And essentially, this looks at what is effectively a highly concentrated supply chain for AI. This goes from the standpoint of the underlying chips to the creation of the models, to the data systems, to the cloud processors. And there's a very high level of concentration in this supply chain. And from the standpoint of thinking about risks in the AI infrastructure, one then needs to think about it from a different lens. One needs to be thinking about resilience. One may need to be thinking about competitiveness. One may need to think about security. But it's very important, given how concentrated this AI supply chain is, that this area around that concentration of infrastructure and the risks are taken seriously. The fourth is what I frame as malicious actors. And this is an interesting one because if I want to categorize where and who are the most active users, particularly of Gen AI tools today, I would frame the malicious actors: fraudsters, criminals, hackers, terrorists. Why? They're not particularly worried about fairness. They're not particularly worried about the fact that maybe it only works 90% of the time. What they are effectively doing is using the new technologies to democratize digital crime. In other words, as a result of the easy availability of digital inclusion around the world, but also generative AI tools, digital fraudsters, criminals, and hackers are now able to reach almost everyone on the planet. And if we think about where are some of those macro risks closest to happening, I would actually frame that if one wants to think about where are we closest to actually seeing self-replicating, malicious AI actors, it's in the fraud and crime area. That particularly in the context of hacking and cybersecurity, where we are seeing the use particularly of machine learning, but also self-replicating malicious systems that are outside of the control of their human creators, this is probably the greatest area. And of course, this requires a very different approach because from the standpoint of malicious actors, our traditional sorts of ways of thinking about regulating responsible individuals don't really work. And so the direction that we're seeing, I think, increasingly around the world is cooperative mechanisms to build digital systems to try to identify, trace, track, and combat this area. But once again, I think that if we frame this risk compared to the others, the regulatory approaches are quite different. And the final piece is around culture. And this is one where, in the education context, we're spending a lot of time. And obviously, we think about things like assessment. We're also thinking about things like research. But what we are seeing in the context of an increasing range of research looking at use of AI tools is a combination. One, that the best results come from use of AI by experts. In other words, that AI tools are particularly effective in the hands of people with expertise. The risk is that, going back to one of those macro issues, that from the standpoint of culture, one, how do you actually go about getting people who don't have expertise, the sufficient expertise to actually make the most of the tools? That's one side. And the second, of course, is the fact that in many cases, we have younger people in particular who default to use of tools in just about any context without necessarily the ability to either have the expertise to interpret or advance the results, but even to critically analyze what comes out. And thus, if we think about from the standpoint of risks in this aspect of culture, once again, the approach is very different. And so, in summary, the motivation for this new paper is really taking the ideas that we framed in the context, particularly of the FinTech book, this idea of a risk-based proportional approach to new technologies, then applying that seriously in the context of artificial intelligence, arguing that we have quite different categories of risks, and that each of these different categories of risks requires a different approach in the context of addressing the risks, but also setting the baseline for maximizing the benefits. So with that, I'd like to pass it over to Iris and Maria.
Thank you, Douglas, for this very fascinating talk. I think by mapping out the risks so very comprehensively and in such a wide-ranging interdisciplinary manner for us, it also challenges the idea that we might be able to just have one piece of either financial regulation or AI regulation to deal with this, which brings us very nicely to Maria's reflections and discussions, which she has mentioned to me earlier will contain some reflections on the EU AI Act. Let me briefly introduce our discussant today, Dr. Maria Lucia Passado. Maria is an assistant professor of corporate law and financial markets regulation at the University of Bocconi, and she was also visiting professor at the University of Notre Dame. Maria holds degrees from Harvard and from Bocconi, and she has published prolifically in Italian as well as in English in many leading American journals. I followed Maria's work on the Oxford Business Law blog and her views on the EU AI Act in particular. So let me now hand over to Maria.
Thank you very much. Please allow me to begin briefly by expressing my sincere gratitude for the invitation to UCL, and in particular to Professor Siu and Arner Donovan, to serve today as a discussant for Professor Arner's timely and thought presentation. It's a true honor to engage with you here, and I think it's a vital contribution to the discourse surrounding AI and its implication for our financial systems. And being discussed in today's presentation, I would say it's not merely an academic exercise, as it often happens to be, but it's an engagement with a technology that poised to reshape the very foundation of our financial systems. So I'll try to venture deeper into the complexities of the presentation, armed with a few provocative viewpoints, especially from a EU perspective. And I'd like to structure my thoughts in two main parts. First, discussing the actual problems that Professor Arner mentioned, and also to mention how the recently enacted AI Act in Europe, and due to its extraterritorial applicability also to non-EU entities at a worldwide level, would alter the regulatory landscape outlined earlier. I think we must try to assess whether the AI Act is a boon or a burden, a shield or a shackle, taking into consideration different viewpoints. First, the presentation invites us to interrogate the very foundation of financial regulation in an age dominated by AI. And at its core, the argument is not simply that AI is a powerful tool in finance, but it's fundamentally altering the dynamics of decision-making and risk assessment. And this transformative force requires us to reevaluate the traditional legal constructs, which is an imperative that is both provocative, fascinating, and also necessary right now. Because historically, financial institutions operated in well-defined paradigms. But institutions were built around the notion that human judgment, despite its own limitations intrinsically, provide a critical layer of oversight. And traditional frameworks, whether they are permissive or restrictive, relied on the assumption that those decision-making structures would be held accountable and that their action would be scrutinized and understood. However, as AI intrinsically assumes a role that once was exclusively humane, this foundational assumption is under threat, because we would need to consider, for instance, the high-frequency trading algorithms that, operating at speeds far beyond human capacity, have been implicated in financial clashes. And such incidents reveal a stark reality. The pace and opacity of algorithmic decisions, the algorithmic leviathan, can destabilize markets before regulators or even the institutions themselves should intervene into that. And this is a prime example of why a risk-based regulatory framework is essential, one that is flexible enough, I would say, to adjust the new pace and complexity of financial transactions. As recalled in depth by Professor Arner, in applying such a risk-based approach, the regulatory shift basically moves from being a one-size-fits-all model to a more graduated and proportionated oversight. And even this nuanced strategy raises provocative questions because, for instance, regulatory sandboxes where AI-driven financial innovations are tested in controlled environments have been celebrated as a way to foster innovation. But these environments may inadvertently create safe havens for risky behavior that, once scaled up, could have systemic implications. And what happens when an experimental algorithm refined within a sandbox is deployed in the market without a robust check that a more traditional regulatory review might otherwise impose? I would say that the potential for unforeseen consequence in this case is immense. And here, the tension between encouraging innovation and encouraging market stability becomes palpable, urging us to reconsider whether our current legal doctrines are sufficient to govern these new realities. Another dimension that complicates the regulatory landscape is the intersection of AI with anti-money laundering measures. Automated systems can also process vast amounts of data far more efficiently than traditional methods, potentially flagging a risk that would have been otherwise unnoticed lead to. However, the same efficiency comes with a significant drawback. The black box is actually leading to several problems, because when an AI system flags a customer or a transaction, the rationale behind that decision may be opaque, even to its own developers. And this opacity is not merely a technical challenge, it's a legal conundrum, because transparency is the cornerstone of consumer protection and anti-discrimination laws. If an algorithmic decision can't be clearly explained, then how can it be challenged in courts, for instance? And this concern is not only hypothetical. Actually, in a world where millions of transactions are monitored by black box algorithms, there is a real danger that mistakes or bias could lead to unjust outcomes and potentially undermining trust in the entire financial system. Furthermore, the evolving landscape of open banking and data-driven finance adds another layer of complexities, because the push towards open finance creates increased efficiency promises and also enhanced customer service. But when AI is integrated into these systems, the risks multiply. And I would say that the risk approach is the leading element that leads me to the second part, mainly the fact that right now we do have a EU regulation that is specifically putting the human-in-the-loop concept coming from Professor Arner paper, but also that adds to this layer the risk approach methodology that we mentioned. Because while Professor Arner framework underscores the criticality of the human-in-the-loop, advocating for internal mechanisms as AI due diligence, AI explainability, AI review committees, the AI Act introduces this risk-based approach, categorizes systems and imposing obligations based on their potential harm. And so we have the high-risk systems designated, for instance, to comprehend AI applications in finance, such as credit scoring, algorithmic trading, fraudulent detection, that requires stringent requirements that recall Professor Arner's point, like compliance with standards, based on the fact that financial institutions must ensure that high-risk systems comply with technical standards, including those related to data quality, transparency, and cyber security. But this complements its call for AI due diligence, elevating it to a mandatory legal obligation, which is key not only for financial institutions, but also corporations at large. Then we have conformity assessments, like independent assessments required to verify compliance before deployment, and continuous monitoring, because ongoing monitoring and reporting are mandatory, ensuring that AI systems perform as intended and do not deviate into uncharted, potentially harmful waters. They do prohibit some practices, they do install some transparency obligation, but I would say that Professor Arner framework promotes a more considered option of AI in finance, that the AI Act proves to be a catalyst for a broader responsible AI innovation, with several implications not only in a financial field, but in those fields that you can see classified here by enterprise function, from human resources, frequently high risk, to marketing and sale, normally low risk. I would also say that all in all, the AI Act main change is to take the internal governance structures suggested by Professor Arner in finance and creates this mandatory set of legal requirements with fines for non-compliance. And all in all, it demands that financial institutions prioritize AI governance and risk management, ensuring that AI serves as a tool for progress, not a harbinger of chaos. And the challenge lies in striking the right balance between fostering innovation and safeguarding against potential risks of AI. The question is whether the AI Act is a sculptor for precision or a bludgeon that inhibits growth, because either way, right now it's here and we must work with its own framework to ensure the responsible and beneficial deployment of AI in finance. And I would say that to conclude, I would like to borrow an example that I actually use in one of my papers, because right now, in my view, the AI Act aims to impose a structure on the evolving landscape, but like Pirandello's 6 characters in search of an author, its key players are manifold. We have developers, financial institutions, auditors, regulators, and their roles must find coherence all in all. So will developers ensure AI models remain explainable and free from bias? Or can financial institutions integrate compliance without compromising speed, scalability, and innovation? Or will regulators craft enforcement mechanisms that protect markets without stifling competition? And these are not theoretical concerns. They define the future of AI and the AI Act in finance. And we are not mere observers of this unfolding narrative. I think we are the co-authors, because the AI Act right now provides a framework, which is not merely a EU framework, as I mentioned, by virtue of its own extraterritorial reality effect, but its real-world success depends on the adaptability to financial markets, where technology consistently outpaces innovation and regulation. As Pirandello reminds us, reality is never as clear-cut as fiction. And the challenge here lies in striking the balance, ensuring that AI fosters efficiency and inclusions without introducing systemic risks or regulatory overreach. And to move beyond the passive interpretation, we all, in our own capacities, need to take a role in shaping the trajectory of AI in finance right now, prioritizing the elements that we've seen today, accountability, transparency, fairness, resilience, with the human in the loop. And if we succeed, we will not just ensure compliance, but we will enable AI to drive a more accountable and innovative financial regulation. Thank you very much.
Thank you. Thank you very much, Maria, for your reflective thoughts. I agree with you very much that the use cases in finance matter a lot in terms of mapping out exactly what sort of risks. And it could well be the case that there are benefits in harnessing AI, but there would be certain permanent risks that may be even very difficult to mitigate. So that kind of trade-off, I think, is a conversation that we need to go on having. And I think the EU AI Act provides a framework that we can work with to start this conversation, because many things are still left to implementation. So it remains me to thank Douglas and Maria very much for your talks today. Very fascinating, opening up the conversation and raising many more issues for us to have future conversations on. So thank you very much. And thank you very much, members of the audience, for sending your questions and for staying with us till the end. Till next time, the Center for Ethics and Law will continue to be presenting some of these very topical webinars that we hope people will continue to come to. So thank you all and have a great rest of the day.